Hi there, this is Rahul Sansanwal. RBI has already released the notification for RBI Grade B exam. Those who know, good for them. Those who don't know, there's a new information, exciting one also. So we know what is the importance of financial awareness in the RBI Grade B exam, either in phase one, phase two, phase one. In general awareness, these kind of any kind of information related to financial awareness can be asked in this particular RBI exam. So basically, we are here to discuss financial awareness, and we will discuss all the financial awareness that happened in the last 1 year, and which is very I think which is enough, and it is very important. All the banking exam, for all the banking exam it is important, but for the RBI grade B exam it is utmost important, so don't skip it out. Now we will discuss what is the prompt corrective action. So this is what we're looking at, prompt corrective action. First we will discuss the prompt corrective action, and then we will discuss what the new thing happened to this prompt corrective action. So prompt corrective action is the restriction. RBI can place restriction on the dividend distribution, branch expansion, and management of the compensation. These are the impact of prompt corrective action. Why it is basically this action is taken by the RBI? Because see, many banks are either they have NPAs, or they are struggling with the banking frauds, or they are not their corporate governance is not up to that level, and that is why the banking frauds are happening in these we know Maharashtra and cooperative banks, this is the great example of this particular thing. So RBI these are the causes of the prompt corrective actions. So what are the effects of these causes? So RBI can place the restriction on dividend distribution, branch expansion, and management compensation. Okay, so any dividend which is distributed by the bank, it can place the restriction on that. Bank cannot expand the branches, cannot open new branches, and also the management compensation which is given by the bank to the management is also restricted. So only in extreme situation would a bank be likely candidate for resolution through amalgamation and reconstruction or winding up. RBI placed restriction on credit by PCA banks to unrated borrowers or those with high risks, but it does not evoke a complete ban on their lending. So yes, it is something kind of RBI is not going to like completely ban the lending, uh, the lending business of the bank. So bank can lend, but in a restricted way, in a restricted mode, not the huge. It cannot open the door for any kind of corporate player or any kind of person who wants a huge amount of funds. I hope you're understanding what I'm trying to say. RBI may also impose restrictions on the bank on borrowing from interbank market. So interbank market, I would say, it is kind of market where one bank borrows from the other bank. That is why it is known as interbank market. Okay, so RBI may also impose the restriction on bank on borrowing from interbank market. Let's say ICICI Bank will borrow from HDFC Bank. This is if this is happening, see, if they are borrowing from the RBI, this is something different. Okay, this is like a repo and a reverse repo rate. I mean to say, reverse repo is different repo rate. So okay, a repo, that, like for example, if they are borrowing for RBI at repo rate, that means they are pledging the securities and they're borrowing from the RBI. So this is something different, and this is something different. This is a matter between the banks. Let's say HDFC Bank and ICICI. This is the exam. These are two bank example. You can take any example of any banks, any two banks, or any three or four banks. So this is the interbank market where one bank borrows from the other bank and it pays it later. Of course, it has to pay. Banks may also not be allowed to enter into new lines of business. If any bank which is placed in the PCA PCA norm, it cannot be allowed to enter into new lines of business. Let's say a bank wants to basically establish a payment bank, a or some kind of any kind of subsidiary banking things, or any kind of new business wants to that particular bank wants to open, so it will be restricted. Okay, so now we will discuss what is the revision. PCA. I'm sorry. I've not mentioned this earlier. PCA was introduced in 2002, and it was last time revised in 2017 after the introduction of Financial Stability and Development Council report on the recommendation of that. So now this has been revised. And what is the revision? This was the thing on which the video is made. So, RBI has recently revised the norms of PCA, in which it has included NBFCs into this framework. Okay, NBFC D, NBFC and D. NBFCs, those who don't know what is NBFCs, I will tell you. NBFCs are non-banking financial corporation, which is completely different from the banking sector. Not completely. Of course, they both related to finance. They both work in work in money and all that. So not completely. I apologize for that. They are different in the way of procedure. Okay, banking sector takes deposit, and you can withdraw the deposit anytime except the bank holidays. Of course, if you do have the debit and credit card, if then also you can withdraw your money anywhere, anytime, at any automated teller machine. So this is something. NBFC, this is the difference between NBFC and banking sector, and which are included. NBFCs in the last year, NBFC has been divided into many layers on the basis of net worth. So on these are included in the four layers: base layer, middle layer, upper layer, and top layer. There are four layers. Okay, according to net worth. So which NBFCs are included? Those NBFCs which are falling in the middle, upper, and top layer are included in this framework. Okay, NBFC is not accepting, not intending to accept the public funds. Okay, now we will discuss those NBFCs, those companies, and basically those financial institutions which are also part of financial framework of the country, but they are not included in this PCA revised norms. They are NBFC which are not accepting, not intending, or not accepting the public funds. Government companies, whether the government companies is an NBFC, they are also not included. Primary dealer, that is PDs, housing finance companies are also not included in this framework. So why first we'll discuss what is the kind of what are the middle and upper layer. So this is something what we're talking about. First base layer, then middle layer, the upper layer, top layer. So these three are included in this. Basically this one. These three are included in this particular framework: the top layer, the upper layer, and the middle layer. Okay, so this particular layer is not included in this particular framework, in the revised framework. This is the 1000 crore threshold. So these are also the NBFCs which are basically divided on the basis of net worth. So this was something we're talking. And now why this RBI has included the NBFCs. We will talk about some causes. What are the causes behind including NBFCs into this revised framework? See, pandemic has hit hard every sector of economy. Every person is hit hard by the pandemic. So NBFCs are not untouchable. So okay, so basically that is why NBFC are also struggling to survive sometimes. They're part of shadow banking. Their fall matters a lot. If they will fall, that means one sector of the finance, one sector of the economy is falling. They're very important part of the banking sector. Banking sector means the the financial sector, where people are taking loans, so they're very important for the infrastructure of the company, infrastructure of the economy. So that is why these NBFCs were included in this revised framework. So happy learning.